In 24% of key audit areas that ASIC reviewed, the auditors did not obtain reasonable assurance that the financial reports were free from material misstatements. This was based on a report by the corporate regulator after inspecting audit files from 20 audit firms in 2018. What ASIC was basically stating was that the auditors did not have adequate documented evidence that could support their conclusions in these areas. These findings erode the confidence users place on auditors and on audit opinions. Let's take an example to understand how this could happen. Mufasa is an auditor of Lonsdale Proprietary Limited. The company has 2,500 debtors at year-end. Mufasa sends external confirmations to 10 of the customers, representing 0.4% of the total debtors balance. All confirmations are received back and no discrepancies are noted. Mufasa concludes that based on this audit evidence, the total debtors balance is free of material misstatements. No further audit procedures are performed on debtors. Would this be considered adequate audit evidence that the debtors balance is not materially misstated? The answer is no. But why? Firstly, the audit procedures are not comprehensive. And secondly, the sample size is too small to be representative of the total population. According to ISA 500, the objective of the auditor is to design and perform audit procedures in order to obtain sufficient appropriate audit evidence so as to arrive at reasonable conclusions on which to base the auditor's opinion. In other words, the auditor should be led by the evidence, and the auditor's conclusions or opinion must be based on the evidence gathered during the audit. Sufficiency and appropriateness are two key attributes of adequate audit evidence. Sufficiency refers to the quantity of audit evidence gathered. The auditor will generally collect more audit evidence if the risk of material misstatement is higher. As an example, the auditor will aim to collect a lot more evidence if a client has a history of significant errors than if a client has no such history. Appropriateness, on the other hand, refers to the quality of the audit evidence. It is a measure of both the relevancy and the reliability of audit evidence to support the conclusions reached by the auditor. In other words, there is no point in the auditor gathering audit evidence if it does not support the conclusion on whether the financial statements are materially misstated. As an example, performing audit procedures over sundry expenses of $4,000 in a listed company with total assets of $40 billion may increase the quantity of audit evidence, but it is pointless as it is insignificant and does not help in deciding whether the financial statements are materially misstated. Relevancy deals with ensuring the audit evidence supports the purpose of the audit procedure being performed. As an example, if the auditor is testing whether the debtors balance is materially misstated, then sending external confirmations to debtors to confirm their respective balances is a relevant audit procedure. Reliability, on the other hand, looks at where the evidence was obtained from, how it was obtained, and its nature. As an example, information obtained directly from external parties, such as solicitors and debtors, is more reliable than information obtained from management. This is because management may have incentives to misstate information. For example, they may overstate revenue to earn more bonuses. Generally, the reliability of audit evidence is higher if obtained from external independent parties. Evidence gathered from within the organization is generally more reliable if controls within the organization are effective than if they are not. Evidence obtained directly by the auditor is more reliable than evidence obtained from within the organization. As an example, reperformance of calculations by the auditor are more reliable than those performed by management. Audit evidence in written form is more reliable than oral. Audit evidence from original documents is more reliable than from copies of the original documents. To recap, the auditor must obtain sufficient appropriate audit evidence to support conclusions reached. Sufficiency refers to the quantity of the audit evidence, while appropriateness refers to the quality of the audit evidence. The auditor, therefore, needs to ensure that both the quantity and the quality of audit evidence is adequate and can support the conclusions reached.